There we go. Perfect. Hello, everyone. Okay, I'm going to, can I get screen sharing, Shauna? That's okay?
Oh, yes, sorry.
That's
Yeah.
okay.
Um,
I see some familiar names in here, so it's always nice to see some, whether it's current clients or prospective clients or people in the community. It's always awesome. Okay, there we go. All right, so thank you, Shauna. Thank you, Sydney. Hello, everyone. My name is Andrew Seguin. Today we're talking about cash flow forecasting, right? So you're probably already rolling your eyes behind your head and being like, oh God, I got to stand here for another hour and a half. I'm going to listen to this guy talk about cash flow and finances. It's going to be brutal. It's okay. I will try to make this as best as I can for you. This can be a topic for a lot of people that you might not enjoy, and that's okay. I will start off saying it's okay to suck at this. Okay. This is something that you will get naturally better at as an entrepreneur, as a business owner over time. This is a skill, just like anything else. I suck ass at marketing. I have no problem swearing in that sense because I'm really bad at it. And that's okay. I slowly get better at it. And that's how businesses work. And you will suck at some stuff and you will naturally, hopefully, get a little bit better or at least understand a bit more as time goes on. Okay. So how I do my webinars is a few things. So I have a chat screen open on one side. You can always unmute yourself. You can always type a question in the chat if you don't want to talk on the microphone. I really want to do it like an open session. Okay. So, and never feel bad. Never feel like you're being judged. Any question is a good question. Okay. Because that question that you're asking has probably been asked before, or someone's thinking about it right now. Okay. So I really want no judgment. I really want you to feel you're in a safe space to ask any question you are thinking about. You can stop me when I'm talking. You can wait until the slide's over at the end, whatever you prefer. I usually like you to just stop me where I'm at right now. That way we're sort of actively talking about that specific talking point. Okay. So a little introduction of who I am. I am the founder of Seguin Financial. My business has been open for a little over 5 years at this point. Essentially, we are a paperless and cloud-based bookkeeping and tax firm. Our business is primarily located in Cornwall. We have a building on Notre Dame Street and 13th in the corner. Bought that building right before COVID. Got my renovations done before COVID, so I was very lucky in that regard. But we work with a lot of clients all across Canada. I have a client in BC, I have a client in Newfoundland, but our sort of bread and butter is in Ontario, because each little province has their own sort of special nuances about taxes and payroll and such. So a lot of our clients are within Ontario, but we are fully paperless, cloud-based, meaning we use a lot of technology, a lot of software online. I'm currently working from home right now. I have a team member in Windsor, I have a team member in Peterborough. So, this allows us the flexibility to essentially work anywhere we want if need be. So we've been in business over 5 years now, and it's been an amazing journey. And as Shauna mentioned, I was a CBEC recipient as well when I first started my business. And now we're a team of 9 full-time staff members, including myself. So it's been great. It's been an awesome journey. Okay, so today, this workshop, we're going to talk about what a cash flow statement is. So kind of give you a general idea from my perspective, okay? Talk about why do you need to have cash flow statements in the first place? Some misconceptions about cash, some tips and tricks from my end to help manage cash, and then we're going to spend a lot of time in regards to an actual template forecast that I've helped build that will hopefully make this all come together at the end. Okay. And again, you can raise your hand, you can unmute yourself, you can type in the chat, whatever you want in regards to ask me questions, you have that full capacity. Okay. All right. So what is a cash flow statement? Essentially, it tells you how much cash is entering and leaving your business in a specific period of time. Okay, so you're essentially looking at, in a micro lens in your business, a period of time, the cash that's coming in, the cash that's going out. And cash is pretty broad, right? Cash is coming in a lot of different ways, whether it's e-transfers, checks, direct deposit, whatever, but that's all cash related items, right? So your checking accounts, your line of credits, all that is cash items, right? So it's looking at the cash that's coming in, the cash that's going out. And it's one of the three major reports, when it comes to building a business plan or a forecast. It often goes alongside the income statement and a balance sheet. Okay, so the cash flow statement is one of the three major pillars in regards to looking at a business forecast, right? You're essentially determining at any point in time what type of cash position you're going to be on a monthly basis, a quarterly basis, a yearly basis, and so on. So income statements, which essentially taking your sales minus your expenses, it's really helpful in regards to showing where you've spent the money and how you've earned the money, right? But they don't really necessarily tell you how much cash you have on hand at a very specific point in time. Okay, so that's where the sort of differences between an income statement and a cash flow primarily come from. But cash is king, right? At the end of the day, you need to ensure that you're properly tracking your inflows, money coming in, and your outflows, money going out. And it's super crucial for any business owner. But why do you need a cash flow statement? Right? I've kind of told you what it is, but why do you need one? And if you're like, well, if I'm already tracking my income expenses, which I hope you are, that's like level one, in my opinion, to like understand the profitability of your business is to track your income and expenses. And you could do that in many different ways. Doesn't matter which way you do it, as long as you do it a specific way that works for you. Might be saying, well, why do I need to also track my cash, right? If I'm tracking my income and expenses, aren't I sort of tracking my cash? Well, not necessarily. In Canada, okay, we work on what's called an accrual basis system. Okay. Essentially, what that is the most basic example I can give you. Let's say I invoice a client on April 30th for $5,000. Okay, so I've incurred revenue of $5,000 on April 30th, but it takes me 30 days to get paid. Well, that's the difference between the accrual basis and cash basis. Accrual basis is I'm going to show the revenue in my books in April. I've invoiced my client for $5,000. They haven't paid me for it yet, but I'm showing the revenue right then and there in April. But for cash purposes, it might take me 30 days to collect it. So I'm only get that cash at the end of May. What if I don't get the cash at all? What if they only pay me over 6 months? What if they have to go to collections, right? So there's a big difference between accrual and cash. In the US, they work off cash basis, which is like, they don't really care when you've invoiced. They just really care about when the money hit your bank accounts, for instance. In Canada, only like farm businesses, for instance, can actually work off cash basis. Every business will work off an accrual basis. So the first question is, is it, where the concept of projected revenue comes in? Yeah. So projected revenue, you're going to work off accrual basis. You're not going to really work off of when I'm expected to get that money to my bank account. It's really, when am I going to incur these services? When am I going to earn to do the actual services or selling goods? Now, some businesses might naturally be cash basis. A restaurant, for instance, right? Typically, you're not doing a lot of work and waiting to get paid, right? You're selling food, desserts, alcohol, and you're getting paid that same day. There's might be like a 1 day, 2 day sort of delay in like your payments from your credit card company, but most often than not, it's cash basis. Let's just say, like, you provide your service, you get paid that same day. Retail, same thing often, right? You sell a good, you get paid from your customer. But it doesn't always work like that. Retail would have an accruals concept where, you might get a large bill for inventory for $5,000, but it might take you 45 days to pay it. So at the end of the day, this is a large difference between an income statement and a cash flow statement, because in my income statement, I will show that $5,000 in April, but I might not get paid for that until May, right? So it's why they kind of go hand in hand. And And you'll see in a bit where income statement is a good report, but it shouldn't only be the report that you're providing to, the part of a business plan or for projections. So another concept, which I won't go too much in detail, but it's helpful to know, is that there are some transactions that can occur in your business that actually is an expense, right? So it'll show up on the income statement, but actually doesn't affect the cash account. One of the big ones that you might have heard about is depreciation. So, if you buy a large capital asset, let's say you buy a $20,000 piece of equipment, let's say you paid in cash. So you paid $20,000 in cash. That capital asset actually won't show up on the income statement because the government says you can't write off, you can't expense outright a large piece of equipment. You have to depreciate it over a period of time. It's a tax concept, which again, I won't go too much in detail, but that's a big difference between what your income statement will show and your cash flow. You've lost $20,000, right? You've got this piece of equipment, but it's not going to show up in your income statement. And that's why there's one of the big differences there. When doing your books, when do you indicate it? The month of the invoice or the month when you actually get paid? So it's a really good question. So for your income statement, like when you're doing your books in QuickBooks Online, Xero, Wave, Sage, whatever, you're going to put down, it's two pieces of information you're putting down. When am I invoicing? So I'm invoicing April 30th. So that's going to record your revenue on April 30th. And then when you finally get paid for that invoice, May 31st, you'll also go back in your accounting system and say, I got paid May 31st. And then you'll have one transaction, the first one, showing on your income statement, right? Increased your revenue. The second transaction, when you got paid, your income statement doesn't change. You've already showed the revenue, but it's the cash position that's changing, which will now naturally change your balance sheet and your cash flow statement. Hopefully that helps answer that question, Angela. But you would record it two times. First, the invoice itself, and then when you actually get paid for that invoice. What if you lease that piece of equipment? So if you're leasing a piece of equipment, there's two types of leases. There's an operating lease and a capital lease. An operating lease is like you're renting. So if you've ever leased a car, for instance, more often than not, it's an operating lease. You're just renting that car. You don't truly own it. You can actually expense that lease every month or every payment. A capital lease, you often see that for like larger machinery. So let's say a construction client is buying a $200,000 John Deere tractor. A capital lease is like you're making payments per month with the expectation that you're going to pay $1 at the end. So you own it. That is treated differently than operating lease. I won't go into nuances about that. But it's a good question. But typically, a typical lease, you're going to expense it, and that will show up in your income statement every time you make a payment. So how would you expense a big expense like equipment or appliances? So that's where that tax concept of depreciation comes in effect. So the depreciation itself is your expense. And again, I won't go into nuances about that. If you want to know about it, just type in what is depreciation in Canada, and some concepts and some stuff will come up. But essentially, you only get to write off a percentage every year. So they say, well, you can't write off $10,000 in one shot. We're going to allow you to depreciate it 20% a year. And that's the concept of depreciation, essentially. Okay. Good questions, guys. I love it. Keep it up. And seriously, if it's like, ask away however you want. So, to kind of broaden the concept of depreciation, it's where there's a big difference in this case between your depreciation showing in the income statement, but at the end of the day, your cash transaction of you buying that equipment or getting a loan, right? For instance, getting a loan would show up in your cash flow statement. It wouldn't show up in your income statement. So this is where you kind of need to bridge them together sometimes. And they always get bridged together. Like if you're doing it correctly, an income statement will always tie into a cash flow, and then cash flow will always tie into an income statement. Like it's just accounting in nature. Like there's always a left entry and a right entry. So at the end of the day, it always comes together if you're following the accounting principles. You don't have to, but like if you're putting your stuff in an accounting system, it'll always be balanced out. Okay. So misconceptions. Okay. So it's important to understand what I'm talking about here. So this is where I think people often get confused. And it's really important to understand the next like 5 minutes what I'm talking about here. Okay. So whether you're a new business owner starting off, you're thinking about starting a business, or this is not your first rodeo, right? You've been doing this for a few years already, or want to start another business. And here you are. You want to know more. You want to gain more knowledge, gain more experience. That's awesome. People think that, having profits in your business actually mean cash flow. And that's not always the case. If you kind of go back to my prior example, right? Let's say you invoice a client for $20,000. Well, that's profits for you currently for accounting purposes and tax purposes, but have you gotten paid for that? Not yet, maybe. Maybe it'll take you a few months. Maybe you never get paid at all after about a year and you're frustrated and you got to write it off. That can happen. So looking at a business's financials and saying you're profitable, that doesn't always mean that you have strong cash flow. Construction businesses is one that will often be profitable, but have horrible cash flow. Why is that? Well, it's because it takes them forever to get paid from their customers, right? But they have to pay their labor. They have to pay the materials, right? WSIB, overhead, they're paying for all the things and waiting to get paid from their customers. And their customers are getting invoiced large amounts, right? Construction businesses are often invoicing 20, 40, 100, 200, $500,000 invoices. And they're trying to get that payment occurring, throughout a period of time. But profitability doesn't always mean cash flow. And that's where, you got to kind of look at both together. Some businesses, they will often be one-to-one. Like I said, restaurants, retail businesses, service-based businesses will often you invoice, you get paid. There's not really a large delay. But some businesses will naturally have a large gap difference between the two. Okay. 2, you can never have too much cash. So this is a bit more nuanced, but at the end of the day, if you're sitting on so much cash, it can potentially hurt your business, right? It's that, cost benefit analysis, right? It's this essentially, if you're not using your cash for something, are you potentially losing out on additional profits? Most of the time, the answer could be yes. Not always, right? If you're like, well, I don't want to be too risk adverse. I don't want to be taking my excess cash and investing into something that might not work out, like a big piece of equipment for large businesses and customers, but that doesn't end up working out. But most of the time, if you're sitting on cash, it means that you're not fully utilizing your excess profits, your excess cash basis to make additional compounded profits, right? It's like having savings, right? Your savings will naturally earn money, but it won't be as much as you took it and you did something with it, starting a business or, leveraging it for whatever else. Now, this is more of a personal, in my opinion, personality thing. Some people are like, I don't mind having excess cash. That's a good feeling. I can sleep better at night. Nothing wrong with that. Okay. Nothing wrong with that at all. Some people are like, I always want to be thinking about the next big thing. And having excess cash will not allow you to do that next big thing, whether it's expanding your business, hiring new team members, buying a building, growing your business, making another business, whatever that may be. By not utilizing that cash, you will not be able to do those things as easily. Okay. This is a big one. I would say, like, if you're already starting to snooze and wanting to fall asleep right now, I get it. But this is the big one right here. And this will often get questions and people are like, I don't get it. What is it talking about? Okay. You drawing out cash out of your business as a sole proprietor You're like, oh, I heard that word before, sole proprietor, sole proprietor. If you are a sole proprietor, which is a heavy majority of businesses, right? You start off, you get a business name, you're a sole proprietor. Like you are a sole proprietor, whether you registered your name or not. If you start a business idea, you're a sole proprietor. It's only when you actually legally incorporate, you're not a sole proprietor anymore. But I guarantee a lot of you in here are sole proprietors. Okay. You taking money, taking cash out of your business bank account has zero effect on the profitability of your business. It's not an expense. And that needs to be like ingrained into your brain. Okay. Because I will often get about 10 to 15% of our new business clients being like, why am I paying so much in taxes? I didn't take any money out of my business. You taking money out of the business has absolutely zero effect, no bearing on the profitability of the business. The profitability is the profitability. What did you make in the business, regardless of how much money you took or didn't take out of the business? So when you're looking to do a cash flow projection or an income statement, for instance, and we're going to go through my template, you won't show your draw as a salary. You won't. Your drawings, which is you taking money out of your business bank account, is not an expense for the business. It's not. If you're incorporated, that might be and can be different, right? But as a sole proprietor, you taking money out of your bank account is zero effect on the income statement and it's zero effect on that profitability. And it's solely reflected on the cash flow statement and on your balance sheet. Yes, I do recommend, I think having a business bank account, even at my size of the business, I have a $5 a month RBC digital account. I get free e-transfers outgoing, unlimited e-transfers incoming, unlimited electronic transactions, no bare minimum monthly balance. It's $5 a month. It's just 100% the best thing you can do for your business. Because what will happen if you register your business as a name, so instead of being Andrew Seguin, it's Seguin Financial. I've registered myself as a business name. You actually can't deposit a check. If you go to the bank, you're like, and someone cuts you a check for Seguin Financial, and you try to go to the bank and deposit that in your personal bank account, the bank will often decline that. They'll say, we can't allow you to deposit this. It's not matching. So you will naturally need a business bank account under that business name. What is a good ratio between keeping and spending cash flow? Someone wrote this, but came directly to me instead. That was really tough. I would say it depends on your industry. So like some businesses can afford to be a bit more aggressive on cash usage. Like constructions can't. Construction businesses, like they can't just be getting new equipment left, right, and center and having substantial debt. Like there's a really good balance there. Service-based businesses will often have more flexibility because your time is your money. So, when you're spending 20 hours in your business, you're often billing out 15 hours of it, so you're often getting paid right then and there. So there's a bit more flexibility there, but that's a really tough question to answer. That's really more like your business industry, you personally, your business growth. This is a lot to it. But I want you guys to understand this concept because it's going to affect your tax return. It's going to affect how you understand, your profitability, your projections. If you take $0 out of your business bank account and your business made $100,000 in profits, you will get taxed for $100,000 of profits, regardless if you took out zero. Other way around, your business made $0. You got a bank loan for $100,000 and you spent it all on, plane rides and vacation trips. It doesn't matter. At the end of the day, you're not going to owe any taxes because you didn't make any money. But now you have debt, right? You have $100,000 of debt you have to service. That's a whole separate issue, but you won't owe any taxes because you didn't make any profits. Okay. So the government doesn't care as a sole proprietor what you take out, what you put in has zero effect on the profitability, zero effect on your taxes. Okay. Does everyone understand that concept? Okay. And it's okay if you're like if you want to ask a question, you want to unmute yourself, now's the time to do it, or you can wait. That's no problem there. But get that, like, your profitability determines what you pay in taxes. Okay. And we're going to go through that in the spreadsheet template. This is a big one. Definitely a big one. HST, no. So I have a few different webinars on many different topics. HST is another complicated, fun one. But no, HST is not for the scope of this webinar. It's really more like cash flow projections and understanding the concepts behind that. So some tips and tricks, finance big buys in a day. There's nothing wrong with that. In this market, it might be a bit more difficult, right? 2 years ago, you can get financing at, the big banks, 5, 6, 7%. Now you're looking at 9, 10, 11% maybe. So this is really more of a, make a decision in the sort of picture of the economy sort of choice. But it's often can be a good idea to finance a big purchase as opposed to draining all your cash. This way you spread out your payments and it gives you that sort of flexibility to make different decisions on the cash that you're sitting on. Okay. This is a big one, I'd say. Speed up your inflows. So, sending out your invoices quicker or asking your customers to pay electronically will just naturally increase the speed of how fast you get paid, right? In this day and age, in 2023, customers, businesses, individuals, consumers, they want to pay by credit card or by e-transfer. So if you don't give them that opportunity and you only allow them to pay by cash or by check, you're going to slow down how fast you will naturally get paid. So at the end of the day, there's software out there that can make that a bit easier. Justin's about automated recurring billing. Yep. So I use automated recurring billing for all of our monthly clients. I get paid on the first of the, money comes out of their bank accounts on the first of the month to pay my bill. And I'm not chasing my customers for invoicing. And I say, you can't even be a client unless you sign up for this monthly recurring bill. And that works for us. Might not work for you, and that's okay. But if there's other opportunities out there that can allow you to speed that up, it's just, you don't want to be waiting too long to get paid. Because think about this. If it takes you 20 days to send out your invoice, there's a good chance they won't pay that invoice right then and there. They might wait another 15 days. So now you're waiting 35 days from the initial date that you should have invoiced. It's a long time, especially depending on your business. You've already paid some labor, materials, overhead, right? You might have paid for things out of pocket to do this work, right? Trades, contractors, that's often the case. You're paying for materials out of pocket and you're hoping you get paid. So another one is, I don't mention about retainers, deposits. That's something I've been doing a bit more over the last 2 years, is asking for a deposit for your services upfront. So if you have a quote, let's say in the construction business, even services too, it's like anything that's going to take you a good amount of time to complete, don't be afraid to ask for some money up front. This way it minimizes your risk, right? So Justin's right there, like minimize your risk. At the end of the day, you want to get paid for at least your time, bare minimum. And that 50% covers that risk. And the other 50% should be essentially your profits. So at least it covers your time. And I always say, if a customer is not willing to pay you for a deposit upfront with a contract, it's probably not the best customer to be working with, right? It's like, if they're not valuing you right then and there for a deposit, who's to say that they're going to pay you or give you issues when it's time to collect? So just be wary of that, okay? Monitor your cash flow. So I mentioned the accounting system a few times so far in the first half hour. I think depends on your business. It can be very helpful. Yes, there's a fee to it. Not always. Like things like Wave Accounting is free. It's a free accounting app. It's not the greatest app. I do recommend it for like small sole proprietors that want to get their feet wet with tracking their invoices and tracking their expenses. It's good. It's not the best. It's good. But tracking that, right? Tracking and monitoring your cash flow is super important. And not just how much money am I in my bank account, but what's upcoming, what expenses and bills are upcoming, what invoices have I invoiced that I am expected to get paid. That's where a lot of people make mistakes, is they're only looking at their bank account. They're like, oh, I have $4,000 in my bank account, I'm okay. It's like, yeah, but you have a check that's outgoing for $5,000. You're hoping to get paid for $2,000 tomorrow, and you have payroll coming up next week. It's like, you got to juggle these things in your brain that can get pretty difficult. Utilize an accounting system like Justin just mentioned, Wave. It's just a good starting point. And I think it's really important this day and age to kind of start with something. Okay. Break even. This is a big one. Okay. So understanding how much revenue you need to bring in to break even is, I think, quite underappreciated. It's a ratio, it's a formula, it's a calculation that I do for all of our clients, because it gives them an understanding based on their current spending habits, how much money they need to bring in to offset those costs. So break even is really important for businesses like retail, construction, restaurants. Restaurants is a big one. I don't know if anybody in here is looking to open up a restaurant. It's very difficult, very difficult, very difficult. So understanding, understanding how much money you need to bring in to cover your margins, cover your food costs, your labor, and your overhead is something that like really you need to take in consideration. And if you don't know how to do it, just type in like how to calculate break even, and it'll give you the formula there. It's a pretty straightforward formula, but it's helpful, right? It helps you understand how much revenue you need to be pulling in to cover your expenses. So check that out. Okay, so we're half hour in. We have, so what we're going to do is we're going to spend 30 minutes, take a little, maybe 20 minutes, take a little 5-minute break to kind of get the cobwebs out, go to the bathroom, get some water, get a coffee, whatever, scream in the pillow, whatever you want. And then we're going to start the concept of looking at this spreadsheet that I built over the last little while. And then, like I said, around like 12:55, we'll take a little 5-minute break, and then we'll come in and then we'll continue. Okay. So I'm going to share my screen again. This time it's going to be sharing my spreadsheet, and Shauna and Sydney will be sending this out for you all to utilize as much as you need. Okay. So let me.
Andrew, I'm just going to say one thing. So we have shared your one from previous sessions.
Yeah.
So Andrew's updated it over the last between now and our last session. So we'll send you out the more recent one.
So it's very small updates. There was like some formatting, and I think I added another expense category too that made sense in my opinion. Okay. So this spreadsheet. So you can open this and use this in Google Sheets. So if you're like, I don't have Excel, you for sure should be able to download the Excel spreadsheet and open up in Google Sheets. And that's free, right? Anybody can open up a Google account and use Google Sheets anytime you want. So you don't need Excel to use this, by the way. So keep that in mind, okay? And if you ever want to sort of, refresh your memory on how to use a spreadsheet, I made a video that you just click here, access anytime you want. I think it's like a 30-minute plus video on how to fit this out. There's a possibility that I might not fully expand on a specific topic or think how to do something in this webinar, but that video will more than likely expand on that specific thing that you want to learn, whether it's like the loan calculator down here, which is a whole complex sort of discussion point. But if I don't cover every single thing here, there's nothing wrong with going to the video, speeding up the video like 1.2, 1.5, and like sort of refreshing. Because what I'll say is this: if you're not familiar with Excel or Google Sheets and you're not comfortable with finances, you might have to like watch this video once or twice. Okay. And that's okay. Again, you have access to that video, play around with the spreadsheet as much as you want. And only by sort of practicing this will make sense. So I kind of make this spreadsheet. It's simple, in my opinion. Okay. At the end of the day, this spreadsheet, I didn't want to make it too complicated. And with that simplicity sort of concept behind it, there are things in here that I love to do that I just couldn't do for the sake of building too complicated of a spreadsheet or complicating the crap out of you. Okay. So that means that I've only put down 6 income sources when you might have much more. And I'll talk about that concept later on. I built a very basic loan calculation here that actually might not be fully 100% accurate. It might be 95% accurate, but not 100%. Or there might be additional categories of expenses in here, which we'll talk about in a sec, that might not be applicable to you, or you might want to add another category. But again, I didn't, because I didn't want to make the spreadsheet so large, so complicated. I really try to simplify it as much as I can for you. Now, if there's a specific thing that you really, really need in this spreadsheet, I would say reach out to Shauna and Sydney. It can always, this spreadsheet is always being redeveloped every 6 months or so, just based on what's happening in businesses, what people need, and what I think makes sense. I'm pretty happy with this version. It's like version 3 at this point, version 3, version 4. So let's just jump into it, right? So you essentially fill in the yellow cells if it's applicable. So this spreadsheet, in my opinion, is broken down into 2 different ways you can do it. You have a business that you are essentially a service-based business, okay? And then there's another business, which would be you're buying and selling goods, or you're buying and selling goods in any way, whether you're a restaurant, a retail, a manufacturer, whatever, okay? So for now, for the concept, I'll start off the easy one, which is you're a service-based business, okay? So me. You can type in your business name here. What happens is all the stuff gets referenced. So like now it's showing Seguin Financial, before it was blank. First month of forecast, you essentially want to do that, in my opinion, where you're at today. So if you're building a forecast for your business today, you would want to start May as your first month, okay? Because then what happens here is that trickles through now a 12-month period starting from May. Okay. Now, you might be like, it's just easier for me to do January to December. And that's okay if that makes sense for you. The only thing about that is if you're only starting your business now and you do January, well, a lot of this is going to be blank, right? You got like 5 months, 4 months of the spreadsheet that might be mostly blank. No revenue, no expenses. So you're getting less projections out of it. So it's why I often recommend start, we're like, I'm starting my business in June, I'm starting in July. That's your starting point. Now, when I say starting your business, I don't mean when you're getting income. I mean, like, I am spending money now. I am in the concept of spending money to build my business. That is your first month of forecast, right? It might take you 3 months. It might take you 6 months to get your first customer. That's okay. You need to track how much you're spending. And that is your first month of forecasting. So for this, let's say baby Andrew is starting his little Seguin Financial bookkeeping business, right? I'm ready to go. May, I'm ready to rock and roll. So that's my first month. Again, you kind of see that it automatically does all that for you. Begin cash flow. So how much money do you have available right now? Might be 0. It might be $1,000 you have from savings. You put that number here, that number will start you all the way down here as your beginning balance. You'll notice that a lot of this is formula driven, as in like, you don't have to worry so much about making sure Excel formulas are working, that's already done for you. It's the amount of you putting the numbers in, and all the hard work and heavy lifting will be done for you. So beginning cash balance is not just how much money you have in your business bank account. It's really how much money you have access to for your business. Okay. So, at the end of the day, you might have, a family might have given you a $5,000 loan, and like they say, pay back when you can, but you don't really want to track it down here. It's more of a personal loan, not a business loan. Well, that would essentially increase your cash, right? So you'd say, I have $5,000 to start off with, not 1,000. So let's start off with 5,000. This part here is really important. So I talked about a while ago how you taking money out of the business is not considered an expense, but it still needs to be determined of how much money you want to take out. Okay. So let's say I want to take out $40,000 a year. I put down before taxes. The reason why I say before taxes, because your unique situation is different than everyone else. What I mean by that is, if you are working a part-time job and running your business, your income is different. If you have rental properties, your income is different. If you're doing this full-time, your income is different. If you have investments, if you have whatever, everyone's income is different, and your tax specific situation is also different. Do you put money in RSPs? Do you have childcare deductions, tuition? I don't know. So I put down before taxes. And the way to think about this is if you wanted a salary in your mind, I'm familiar and comfortable living off of $50,000 a year before taxes. That was your salary when you were working, if you were working. That's a good starting point. Now, what you're going to owe on taxes on this, remember, this has no bearing, right? This draw here, what happens is I don't show it as an expense. I show it down here as a distribution. So it's you taking money out of the business, but it has only an effect on the cash position. It doesn't affect your profitability. Okay. Now, my formula will take this figure and divide it by 12. So 50,000 divided by 12, right? If you go down here, it's this number every month. This is a starting point, but you have an opportunity to say, well, I don't really need money in the first 3 months. You can overwrite the first 3 months and put it to 0. Okay. But all it's doing at the beginning, it's saying 50,000 divided by 12. That's your starting point. Now you can, and I would recommend, if there's one thing to override in the spreadsheet, would be this section here, because what you need to live off of personally is your own uniqueness. Okay. So what you need to live off of as a draw, as a sole proprietor in your business, is unique to you. And you might need 50,000, but maybe it grows. Maybe it's, $5,000 a month, like this. And maybe it goes up, maybe it goes back down. That's okay. You have the complete access and right to change this as you see fit. And I would recommend for you to do that. Okay. And you could do that for both years. So what happens here is there's a 2-year tab. So we start off with year 1, and then a lot of these figures carry forward into year 2. So now you can see here, end of year 1, unfortunately, I'm negative $45,000, right? At the end of April, that carries forward into year 2. So a lot of the stuff will be sort of carrying forward from the prior year. So do you guys understand that concept? This one's important, okay? So if you put $10,000, all it's going to do is going to take that number divided by 12. But you can absolutely override this number for what you need. First 3 months you need 0, and then it goes to 1,000. Do that, baby. Whatever you want. Okay. So you can download this Excel, Melanie. You can download this Excel spreadsheet, or the copy that the updated copy that we're going to provide you, and just open it up in Google Sheets. So there should be just a click and drag, or click open, and this spreadsheet will look and should look very much the same. Okay. So understand the concept of distribution. Pretty important here, okay? Because this is like your major, often depending on your size of business, is your major cash flow transaction. Are you taking money out of your business to live? Yes, absolutely. Very important. Very, very, very important. So you can kind of see here that, we started off with $5,000 and this money is now, my ending balance is getting smaller and smaller. And what I've done is I've highlighted in red critical points. Look here, look at me, right? This is not a good situation to be in. You're in a negative position in cash. So this is why you're projecting. You are projecting at any point in time, am I going to be at a critical point in my business that I need to make a decision? Do I get a loan? Do I increase my pricing? Do I decrease my costs? Those are all different options, right? So looking at these red cells, very helpful. And the red cells will show up as well throughout here shortly. So that's our starting point. Okay, so we have distribution. I will modify this later on, but let's say it's $25,000 and $50,000 year two. I deserve a raise, right? Why not? Inventory. I'll come back to this after the break. Inventory can be a big one. But very, very quickly, what I consider inventory is something that you are tracking. So a restaurant will often not have inventory because they're often buying and using it up in the first week, right? Retail is one that would have inventory. You might buy something and it might sit on your shelf for 3 months, 6 months. That's inventory. Construction depends, but often you are buying then using, right? You're making a purchase for materials because you have a job that you need to use the materials for. My business, I don't have inventory. Yeah, paper and supplies, but it's not inventory. Inventory is something that you are buying and holding to resell. Tools wouldn't be an inventory. So inventory is think about like you are buying something because you need to use it to sell. So paper is just an overhead expense account, right? Tools, overhead expense account. So in a service-based business, construction or otherwise, tools and such would be considered more like consumables. Yeah, so down here, I consider those as overhead expenses. So you have conferences, trade shows, you have licenses, insurance, freight, professional fees, rental, subcontractor expenses. Tools might be a good one for the next future version to put down. I think would be a good one, but other costs could be, and you can change this too. Other costs, you might say this is small tools, glass, misc, right? Inventory, the concept is you are buying something to repackage to sell. So food, you buy raw food, repackaging it, selling it. Construction, you're buying lumber and whatever else to make it into something beautiful and selling it. So retail businesses, inventory, yes. I would say service-based businesses, no. Restaurants, no. It's something that you are sitting on a substantial amount. Okay. Inventory is a very difficult concept. I have businesses who have $6-7 million a year in revenue, and inventory for them is still a very difficult concept to track. So if they're not even tracking it that amazingly, should you? Probably not. Okay, that's sort of a kind of an easy answer. But I'll come back to this. What about equipment that customers use, like a rink or skate park? So that would, so that's down here. So in which we'll talk about. So capital asset purchases. Inventory is, again, think about inventory as something that you are actually going to sell. Not equipment or furniture, unless you're a furniture store, but you are buying this thing, you're repackaging it, or you're just reselling it. Okay. But unless you're a retail business, unless you're a manufacturer, unless you're construction with large inventory purchasing, right? Those businesses, other businesses, will often not need to track the inventory. Okay. But again, we'll come back to this in a bit. Oops, sorry. Income sources. So this is where you would type in what are your categories of income? Now, I don't mean SKUs. So when I say SKUs, I don't mean like I sell widget A, widget B, widget C, D, E, F. I sell 100 widgets. I'm more like, what's the category? So for me, you'd be like bookkeeping. That's one of my major income sources. Like I might have monthly bookkeeping, yearly bookkeeping, but I'm not really putting that granularity here unless you want to. Second would be taxes, right? Personal taxes, corporate taxes. Third is consulting, right? I do a lot of consulting for clients that just want to use me for an hour of their time. I charge them for that. It's it's an income source for me. It's a major income source for me enough. And then maybe webinars. Maybe I want to track how much money I make throughout the year for webinars. How is a business best to take into inventory that was privately purchased by the owner prior to the start of business? Yeah, good question. Essentially, that will be your starting inventory. So right here, you put, I have starting inventory of $5,000. Boom, done. Simple as that. And that gets put right here, which again, we'll talk about that concept shortly. What about renting products out? Would that still be considered inventory since I'm getting back? No, that would actually be actually sort of like it's really more like, it's super interesting. I wouldn't, yeah, I guess you can call it inventory, but I wouldn't, because inventory, the whole point is there's a fluctuation happening. It's really an asset that you're renting out. Like that is your revenue source. So you can put as inventory. I probably wouldn't. I would probably put it as a, as a capital asset, which we'll talk about in a sec. Good question though. So these revenue sources will show up here. So I put 6. You might be like, I need more than 6. I get that. Again, I wanted to make it simple. Just try to make it broad as possible. So let's say you're an e-commerce business. And let's say you're selling on Amazon and Shopify. Maybe put that down like this: Amazon, Shopify. That's your income sources, right? Let's say you're a retail business and you're selling clothing. So you might say shirts, pants, dresses, and ties. I don't know. Let's just say, but like, you're not going to be putting down individual SKUs on this spreadsheet. This is really supposed to be a high level projection of your business, right? I'm not going to ask you specifically, how many different types of shirts, like for forecast purposes. On the business plan, this will show up, right? You're planning to sell 40 different products of shirts at 3 different sizes. That's the business plan. But the financial forecast is, how much shirts are you selling? How many dollars of revenue are you producing on shirt sales? That's really what I want to know. Okay. And you might have some information to back that up. It's like, yeah, I'm planning to sell 80 shirts a month. I'm not going to really ask you what sizes, what styles. It's like, how much revenue of shirts are you bringing in? So think about income sources as a category. So for construction, you might say, well, we're doing residential and we're doing commercial, right? That might be one way you want to break it down. Maybe not. You might want to say we're doing, let's say we're doing new builds, we're doing renovations, and then we're doing, small projects, right? Use whatever categories you want, but this is going to be what you're tracking for revenue purposes in the spreadsheet. Okay, so for me, again, it's bookkeeping, taxes, consulting. I'm going to stick with those 3. Here, material supplies, this is what you're putting down if you are essentially, right, needing what's called cost of goods. Okay, cost of goods. So for construction, that would be materials, right? It might be equipment rental, right? Those are examples for cost of goods sold for construction. For a retail business, right? If you're not tracking inventory in the sense, and again, you don't have to, you're not forced to do it, but let's say you're doing, you're tracking your revenue by shirts and pants, you would have shirts and pants as your materials costs, right? For me, as a service-based business, I don't have materials or supplies like this. I don't. It's not something most service-based businesses won't. Restaurants, well, that could be, food, alcohol, right? If you want to break that down a bit further, you can, but it's like, and then you may have restaurant supplies. These are like, napkins and cutlery and whatever else, like cleaning supply, whatever that may be. Like, at the end of the day, do what you can that makes sense, because this will flow through here. And again, it's the concept of cost of goods sold, which is you are having to buy this specific thing. Without it, you would not make any money at all. Like if you didn't buy any food as a restaurant, you wouldn't make any money, right? Now you might be like, oh, there's so many raw materials for food. There's tons of vegetables, tons of meats. I get that. This is supposed to be just a general high level concept. So for me, it's blank, but we'll come back to potentially an example if I have time of what a retail business might look like. So take a little 2-minute break, 3-minute break right now. Okay. And then we'll come back and then we'll start the nitty-gritty of like this part here, year 1, year 2, and how it all sort of comes together. So I'm going to stop sharing my screen. I'll be back in 2 minutes. All right. People, then 10 more seconds. Let people come back. Having fun here, probably. Yeah. Okay. All right. So what we've done so far is we've established the starting point, right? Company name, first month of forecasts, how much money I want, my income sources. Now it's time to start filling this spreadsheet out. In the gray section is the areas that you can put stuff in. Okay. So you are essentially trying to project what you think your income will come in. Now, I mentioned previously that, income doesn't always equal cash, but you can't really easily put this down in a spreadsheet unless you have some very comfortable experience with Excel. So although I mentioned in the first 30 minutes that like, hey, what you do for income doesn't always equal cash. For the concept of this, it is the same. Okay. So when I'm putting down $1,000 of bookkeeping revenue, the intention is that I made that $1,000 in cash, check account, e-transfer, credit card, whatever that may be. That's money I've earned. Okay. Now, it's really difficult to put that concept into place into a spreadsheet where I invoice 1,000, but it might get 30 days to get paid. Okay. This is where an accounting system will really come into handy. But for the sake of having a projection, this is like 85%, 90% of what any business in the future would want. Okay. But if you're looking for like, I really need to get an understanding of my cash timing, having an accounting system in effect will really help that out. Okay. Because it'll track what you've invoiced and how long it's been taking you to get paid for those invoices. But for the sake of this spreadsheet, to make your mind at ease, when you're putting down a number here, the intention is that, hey, I've already made this money. Okay. You've been in business for a year. What would your first year plan be? The one you already did? No, I think I would start. Your business plan would talk about what you've done historically, but a projection is really meant to be looking forward. It's like, so you might, and that just mean you have some maturity. So you were to have some income coming in. For me, in this example, I'm a brand new baby and I'm starting my business for the first time. So my income is going to take some time to start growing. But for you, you might already be starting off day one with, $4,000 a month in revenue. That's great. That's your starting point. Okay. Because you've already been doing this for a little while. You put that in your business plan, but now you're talking about the future, right? You're here because you want to grow your business. You want to expand, you want to, pivot, whatever that may be. You just want to kind of continue and leverage the knowledge that's available to you. That's great. That's like, but your starting point would be May in this case. So let's say start my business in May. I'm doing $2,000 a month. Now, if you are somewhat familiar with Excel, instead of typing things in like this, right? If you can say, if you're like, I'm expecting to do a 10% growth month over month. If you are familiar with Excel, you can do formulas, right? And you can say, well, I'm just going to take this, I'm going to take a formula and say I'm growing 10% from the prior month. You can do that. You don't have to, right? You can just type it in if you want. You can say, I really just want to type it in. There's monthly growth. Oh, it's good to know, Shauna. Sorry, I didn't know. I didn't mean to. But if you want to type in like this, you can. There's nothing wrong with just like manually typing in your revenues. But if you want to use like percentages, like I am expecting to grow 10% month over the month for the first year. Again, this times 1.1. And all I'm doing is I'm just taking the formula and I'm just dragging across, right? So by March, my monthly revenue is now 5,200. Now 10% monthly growth might not be realistic for some businesses like restaurants, because it's kind of hit a peak pretty fast and can't really grow too much. There's a certain capacity limit, but for me, it might be possible, right? So for now, for the sake of I'm just going to go 1.1, a 10% growth month over month. But this is where you need to understand your business. I can't answer that for you. You've done your research. You probably have an understanding of what you think you can pull in. And this forecast projection will tie it all together, right? You know your business more than anybody else, right? All we're looking at, like when I'm a grant panelist, I'm looking at the financials primarily, right? Yeah, I get understanding of your business concept, your ideas, what you've done, but like, is your business financially feasible? And this is what you're telling me. You're telling me that this is what you're expecting to bring into your business. And only you will know that based on your research, your understanding of the market, the industry, what you can do. So keep that in mind, okay? So taxes, let's just say that like, it's $1,000 and it kind of slows down, right? I'm starting my business at the end of tax season. And let's say it's zero across the board. Consulting, it's to say I only start this around here, it's here, and let's say I do $500 a month. And again, you can just copy and you can paste it, right? So if you want to type it out, please, you absolutely can do that. There's nothing wrong with doing that at all. Let's say taxes now start picking up again. So we have $4,000, $5,000, and $6,000. So right now, my business is generating this much income per month. So it kind of gives you a little formulas, 3,000, 2,700, 34. You also can click this little button to kind of say, I don't want to see all the detail. I just want to see how much income I'm generating. This is helpful if you want to see like super quickly, get rid of all the noise, just like, so if you click this little like 1 and 2 button here, you kind of like, so I made it just like, this is getting rid of all the noise, just like income, gross profit, total cost, net income. It just giving you a very high level sense. Detail is obviously important to get the information. If we're starting the projection as of May, how do we add the equipment tools purchased in the past year? Yeah. So that's not going to really show if you're starting like from May, like you might want to, in my opinion, if you purchase things in January, February, March, you probably would want to put that down. I would say January would be your starting point, and you might not have any income. So it might be zero for the January, February, March of income, but you have expenses. That's what I would do. So if you already started your business the last 3 or 4 months and your income is not starting until June, that's okay. January is your starting point. Show your expenses, and then you'll see that income spike start happening from here on. Okay. So yeah, so this little concept of this, like, it's a little like fun thing, I guess, if you want to, like, again, here too, you can just get rid of all the noise, all the months, just like a nice little breakdown, like a super, super clean breakdown that kind of makes it, it's really a profit and loss statement what you're getting here too, guys. So it's like, if you want to use that concept, please absolutely feel free to do that as needed. So this is my revenue so far. Cost of goods sold for me is 0, right? I'm a service-based business. You know, most service-based businesses won't have cost of goods sold. Then we have occupancy costs. So commercial rent. Now, if you are working from home, okay, that concept for tax purposes is different. So like if you are renting a commercial office for $1,000 a month, you would put that number down, right? You would say $1,000 a month. So you would for sure just put that number down. And obviously, for now, just for time purposes, I'm just going to disregard the little format things. If you're working from home and you don't have commercial rent, that's a whole different discussion point, but you can put down a reasonable amount. Like if your total home cost is $2,000 a month, using 10% of your home for your business, you can put down $200 a month. And just highlight that. You just highlight that during your discussion point. Including the tax on my rent. So great question. For the purpose of HST, essentially HST it's not your money. Okay, so for the concept of HST, I would prefer if you didn't track. If you have an HST number in your business, for instance, I want you to put down the number before HST on all numbers. So if I'm invoicing $1,000 plus HST, put $1,000. If you're paying $500 plus HST for supplies, $500. And the reason why is because I don't want you to start figuring out, like, I want that concept of HST being like, it's not your money. So yes, your money gets increased, your cash flow gets increased, but it's not your money. So I don't want you to put that in that concept anywhere in here. That was my professional decision, because HST can really complicate the shit out of a spreadsheet with like how much is yours and what's not yours. And it's just not something I wanted to put that onus on you. Okay.
Andrew, can I ask another question? Just
Yes.
about taxes, but like municipal taxes or city taxes?
Mm-hmm.
Do you add that part?
Yeah. So if you like for commercial space or like home at your home?
Both, I guess.
Yeah. So if you rent from home, if you rent, if you own your own home or you rent from home, essentially it's all your home costs. To Justin's point, it's square footage of your home. So if you have a 10 by 10 office, like I do, total square foot of your home is 1,000. That's 10%. 10% of your home cost, 10% of your property tax, your water bill, your electricity, your heating, insurance, your mortgage interest. So it's 10% of all those costs. But just, you don't have to be specific, just ballpark it, I would say. Like, and you can let, in your business plan know, I'll be working from home, blah, blah, blah. Like, that's like, okay, I see what they're doing. They're putting $200 a month as like their home costs. I typically personally wouldn't even put that in, because this is not extra expenses you're incurring for your business. And what I mean by that is you're not paying more out of your home costs because you're running your business out of your home. It's very minimal. Like your electricity costs shouldn't be going up that much to run a computer, for instance, right? Now, unless you're like a daycare and you're like having a lot more of everything, then fine, obviously, yeah. But primarily, someone like me, I probably wouldn't put my home costs in here, but that's your decision. I'll leave that to you. But you just put down a percentage, okay? And just roughly ballpark. But if you're renting commercial space, you put down your commercial rent. Just wondering if it's best to get HST number. That's a whole like talking point. I love to talk more about it. 17 minutes. So talk to Shauna. I have a whole PowerPoint. Maybe we can just provide to you to kind of go through that. So let's say it's $1,000 a month. So I'm renting commercial space, $1,000 a month. Let's say it's utilities included. Repairs, yeah, I got to spend $500 on new paint, right? I got to kind of spruce it up a little bit. And I have tenant insurance, $30 a month. Okay. So again, you're just going to put down numbers that you've done the research on. You know what space you need to rent. You know what your insurance is. You know all this stuff. You just got to put it down into the spreadsheet. This part, put a little red here, employees only, wages and salaries. So if you need to hire somebody through payroll, if you need to hire somebody, you would put how much it's going to cost. Let's say for me, I need to start hiring somebody in tax season, right? It's like, oh, I'm at capacity. I can't do all this work by myself. So let's say I bring somebody on part-time in February, March, and April. And I'm paying them $1,500 a month. Okay. This is an automated calculation of what's called payroll benefits. So that's things like CPP, EI, WSIB, vacation. Typically, it's about 15%. For every dollar you pay somebody, it's going to cost you an extra 15 cents or 15%. That's a pretty ballpark number. Might be a bit lower, might be a bit higher, right? If you have benefits, like I do, RSP, group benefits, wellness program, it's going to cost you more than 15%. Now you can update this. You might say it's actually going to cost me $275, but it's going to cost me, right? You know, Excel, it's going to cost you 25%. You have that complete opportunity. But as a grant panelist, I wouldn't argue with you if you put down the 15%. And that's automated. Okay, you don't have to worry about that. So all you got to put down is who you're like, how much you're going to be paying for an employee. Employee, not you, employee, somebody you are hiring that's going to be through payroll, not a subcontractor. Okay, a subcontractor is like, I'm going to pay somebody an hourly rate, but they're not going to be on payroll, right? That's very common for construction businesses often, right? You hire another electrician to kind of, do some work for you, right? There's a whole section here for subcontractor expenses. Now, there's also an argument that subcontractors for construction, which I would agree with, is considered a cost of goods sold, but doesn't matter. Just pick one and stick with it. But for me, a subcontractor would be like, I need to hire somebody for 5 hours to help me out during April because I'm so busy. Like I have a part-time employee, they're at capacity. They don't want any more hours. I got to bring on a subcontractor. I got to find somebody online to come in for 5 hours or do some work for me. That's a subcontractor. Okay. So I hiring somebody in February, I have some commercial rent. Then you have your overhead expenses. This is something that I would say when I say grant panelist, I am often, Shauna is kindly enough to ask me to help review some financial forecasts and plans. And I scrutinize the crap out of this part here. I don't like seeing people who are very, very minimal in regards to what they think they're going to spend. Like, oh yeah, I'm going to spend 20 bucks a month in insurance, 100 bucks a month in office supplies, and $5 a month in bank fees, and that's it. It's like, come on, like that's not real. Like I don't know any business that has such minimal monthly expenses. It just doesn't happen. Okay. She was, yeah. So be realistic, right? Like I'd rather you be more conservative with your spending than undershoot. Okay. And this is what I typically say, even in somewhat worst case scenarios or iffy scenarios, if you're still doing well, that means that's good. It's really important for us to see that your business can succeed when things are going to be a little rough sometimes, right? Some extra spending comes in. Like if you have an extra $500 expense, it's completely breaking your business. Well, kind of like that doesn't really look good, right? If you're subcontracted by a company and the contract states that you will pay 30% of your total income, where would you put this in the form? In the contract, you will pay. Oh, that would be like commission expense, essentially. Like you make $1,000, you have to give them 30 bucks. At that point, I would say $1,000 your income, and then you would probably put some type of commission expense here. Like if that's going to be, regular, I would say, and actually what you could do is you can even like do a formula, like I'm going to take 30% of this revenue. Like anytime I make tax money, there's a commission expense, and you can actually do like a formula if you wanted like that. So I would do something like that, I think. But please try to be reasonable, guys. Like when it comes to like website, it's like, oh, you need a new website, $1,000, put it in. Like, I want to see that, right? And then it's like, 20 bucks a month for hosting, put that in, right? Telephone and internet. It's like, oh, I need internet for my office, right? And that's 80 bucks a month, put that in. I want to see those numbers like that. Merchant fees. Well, yes, let's say that on average, every dollar of revenue, I got to pay 1% in Square fees. I use Square at the office. Let's say, for someone paid by credit card or by Interact, there's an average 1% fee. Again, if you're somewhat familiar with Excel, you can do a formula. I'm going to say 1% of all my income. And you just take the formula and drag it out. And it's literally giving you the actual merchant fee costs that it's going to be every month. Or again, you can type it in, right? You can type it in, but I would expect to see increases in merchant fees as your revenue is increasing, right? Because if your revenue is increasing, it's costing you more to get that money. Meals. Let's say I'm going out for some client meetings. It's costing me on average, say 60 bucks a month, right? To build relationships, put that in. Let's say it's cost me 60 bucks to register my business. Put that in. There's some conferences I want to attend in February to get some refreshing on taxes. Put that in. So I put cell phone here and telephone and internet. The difference is cell phone is like you are paying for a cell phone for your business out of pocket. Then there's telephone, which is like a landline, like an internet landline or a physical landline, and internet at the office. If you want, you can put a portion of your cell phone expenses in here. That's up to you. What I mean by that is like, if you're already paying 100 bucks for your cell phone per month and you're planning to use it, half it for business, you can put down 50 bucks a month. Okay. Now, again, same concept with this home office. It's like, well, if you're already incurring these expenses, is this really a new expense? Not really. You can deduct it for tax purposes. Like I would, as your tax preparer, put that in for taxes for you so you can save some money. But as a projection itself, it's really a coin flip. I don't really care which option you want to do, whether you say I'm using my cell phone 50% of the time, or it's a whole new cell phone. Pick one. I don't really care. Identity, just be consistent. Okay, just pick one path, be consistent. Let's say I'm doing some advertising. Let's say I have a few months here, some Google ads, ramps up. All right. So this is my just very general, right? Got some monthly, monthly insurance. It's really, for my business, would be higher, like say 75 bucks a month. I'm doing bookkeeping and taxes. Say it's $5 a month here. telephone, again, like this and like this. All right. So concept is you put down the numbers that you know make sense for your business. And you need to defend these numbers, right? Like I'm going to say, why do you anticipate on spending X dollars in this category? Or I'm noticing you're only putting down $100 for office supplies and you're a bookkeeping and tax firm. Why is it only $100? Like I would expect this to be, much higher, like 250, 150, maybe it's even higher at the beginning. I got to buy some small furniture, a chair, a table, whatever. It's like, let's say it's $1,000 and it's 250. And then it spikes back up. I got to buy some paper, some ink. Like this is what I would normally expect to see, right? So try to understand the concept of what type of expenses your business will incur. Be as accurate as you can. It's not it's a science, but I don't expect you to be perfect, but I expect you to be somewhat reasonable. Okay. So kind of see here, right? Oh, look at that. 1 month. Big loss. Well, yeah, of course I'm at a loss. I have $3,000 of income, but I have some commercial rent. I have some startup costs, a new website, and some furniture. Yep, I have a loss. And it's telling me in red. Is that alarming? Not really, right? I'm expecting to have a loss in the first month, maybe the first 3 months, right? But here, you can kind of see my profitability is happening every month. And then percentages. Percentages are your friend, right? How much revenue are you keeping for every dollar? So every dollar revenue, I'm keeping 37%. This is a concept of margin analysis. Some businesses will live and breathe and die by margins. Construction businesses, margins. Restaurant businesses, margins. Retail businesses, margins, 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 margins. It will seriously help you understand where that's at. And you can find a basic average online, like what a restaurant is. Restaurants typically work on the 30, 30, 30 trifecta, 30% food, 30% labor, 30% overhead. Restaurant has very tight margins. And if you can get an understanding and a solid grasp of your margins, it will make it a big, big difference. I'm not going to go through this part here. Watch the video. It's towards the end of the video. I talk about capital asset purchase. Every single time I do this webinar, I'm like, I wish I had more time. It's always like, I could talk about this for hours. So I do apologize, but essentially what you're putting down here is like, oh, I bought a laptop and it's $2,000. Okay. So this is increasing. So what's happening here? Okay. This $2,000 is showing here, but it doesn't affect your actual profitability or your cash flow. Okay. Get 1927, 1927. What is important is if you're buying it in cash, then you put down the $2,000, but some assets, you are going to finance it over a period of time. So let's say that I buy this laptop and it's a 6-month purchase. Well, you would go 2,000 divided by 6, right? So this is what's affecting your cash flow. So now this number is changing here, okay? So this is an important concept if you are buying an asset and financing it over a period of time, okay? Hence why it's sometimes more ideal to finance a bigger purchase. Yes, exactly. That's exactly it. So, and then you have loans here. So there's a whole, again, in the video, there's a concept about loans. So if you're getting a business loan and there's interest on it, check it out. It's pretty helpful. I go in detail on like how to record it and how to sort of reconcile that. So looking at this, okay, now this is telling me my cash position. It's telling me my starting cash, how much cash I'm getting from income, from expenses. Let's say, I'm in negatives here. Let's say I don't need money in the first 2 months. Okay. Something's got to change. If I don't change anything, when August hits, I'm in a bad position. I'm going to be in overdraft. Right. So I got to make a change. What do you change? Well, you can work more if you can. I'm like, maybe it's not possible. I'm trying to be realistic here. Can you cut costs? Yeah, maybe you can cut costs. Maybe you say, you know what, maybe I don't need a whole new website in May. Maybe I can get it in September. You can make decisions. You can change your numbers around, but you have to ensure that you don't want, like if I'm looking at this forecast and you're in a negative cash position, that's not going to be a good sign. It's like, you got to make sure your projection's been updated to reflect a difference. So you might say, I'm not paying myself for the first 2 months, right? Now you're in a better cash position. So now I can see my cash position going. So you might say, I'm going to increase my cash position in these months to make up, right? To make up for the cash that I didn't take in these months. If I see this concept, I'm like, okay, they're getting it. Like they're understanding that cash is a flexible thing that you can make different decisions on. So this is year one. And then what you could do is you can copy this information and paste it. You can retype it out from scratch, right? You can use formulas. Again, if you're familiar, you can kind of continue that 1.1% increase month over month, right? See how these numbers just changed on me? So this is where that concept of Excel formulas will come in handy. But again, you can just type it out. There's nothing wrong with that. It's like, just type it out, be reasonable, right? You'll have expenses. Again, you can copy your expenses here. You know, is your rent going to increase? Maybe it's now, it's a 5% increase every year. So you put the new numbers here, right? And let's say now the landlord sucks and it's like, now you got to pay utilities out of pocket. It's like, well, that craps. That's, you know, I guess $125 out of pocket I got to spend now, right? And let's say you need more repairs in December. You can obviously understand the concept, but now my business is growing and now I hire a full-time staff member and I pay them $40,000 a year. Obviously, I'm going a little bit fast because we have literally 1 minute, but you get my point, right? So let's say very, very quickly for the sake of time, because you guys have been so kind to give me your focus the last hour and a half. All this is sort of coming to an amazing end, right? So we have year one of expenses and income, year two, and we have this little summary at the end here that's like, holy crap, there's numbers and percentages. I don't know what to look at. This is super cool in my opinion, okay? So what this is doing is giving you a nice little summary of all this junk, all this noise. It's giving you a summary of how much sales you've earned, how much your rent costs were, your payroll costs, your overhead costs. And it's giving you those percentages. Remember I talked about percentages? It's telling me that if I looked at this year one over year two, my net profit percentage stayed the same. That's really good, right? My net profit dollars increase, which makes sense. If I make more money, I should be expecting to have more profits, but my percentages stayed the same. One of the things I often see is that there's a sharp decline in net profit margins. At the end of the day, you know, that can happen, but you don't want to see too large of a spike downwards. It means you're not being efficient with your expenses. So all this is coming together and it's telling you here that, you know, you grew your business 160% in revenue. You know, your net profit growth increased by 158%. You were more efficient with your overhead costs because my overhead costs essentially didn't increase, but my revenue did. So at the end of the day, take a look at this information, but it's going to give you a good concept to work off of. Am I doing my business right? Am I doing it justice? Am I doing okay? If you're seeing stuff like green and good profits, the answer is yes. Obviously, that's not always the case. It might take you 2 years to get up and running. That's okay. But as a service-based business, I often say if by year two, you're not making money, like not actually making profits, there's a problem sort of sitting there, okay? And remember, I increased my distribution to $50,000, right? Went from 26,500 year one to 50,000, and I'm still in a healthy cash position. So if I wanted to, I can say, well, I'm going to go back here and say, you know, because I lived on ramen and sandwiches and hot dogs for a whole year, I'm going to bump up my draw for year two, right? And I'm still in a good position. Now it's close here. It gets pretty tight in these months, but at the end of the day, with tax season ramping back up, I'm back into a healthy position. And there you go. I wish I can talk more about the capital assets and loans, but again, you have those videos, which is why I made it, because every time I do this webinar, I always feel like it should be 2 hours, 2.5 hours, but I know you guys, no one wants that. No one wants that at all.
Thanks, Andrew. It was, it's excellent, and it's a lot of information to take in, and that's why we have you join us twice during the session, so that this is a great introduction. Everybody can digest the information and start inputting some data, and then when Andrew comes back later on in the program, then you'll have like your numbers to think about, and some of the questions is a lot easier to ask and easier to understand because you've given it some thought.
Yeah.
If everybody can stick around just for another 2 minutes or so, I just wanted to highlight a couple of things. Again, as always, thank you to our sponsors, in particular today, Seguin Financial. There we go. Here's the assignment for this week. So you can use Andrew's sheet. That's what we recommend for you to use to create your financial forecast. It works, it's easy to follow. And here's some examples. So that's your assignment due next Tuesday. It could be anytime. It doesn't have to be before our session at noon, just sometime next Tuesday. So we'll follow up with this by email. And very quickly, these are events that are coming up, and I was hoping to get a show of hands or put it in the chat if you could. Our printer is tomorrow. If you haven't got tickets, you can still purchase them online or at the box office. Breakfast Connections, the registration is open on May 17th. And we're also going to be showcasing or launching our new digital service program at that breakfast. So that's very exciting. I'm looking forward to that. And we have a new team member joining us next week. And finally, this is the part I was hoping to get some input from you. I don't know if any of you know Nicholas Seguin from Seguin Creative, Nicholas Seguin Creative. He is a professional photographer and he does film, but he's really great at doing headshots. So if anybody is interested in a CBEC organizing a session where you can come in, book an appointment and have his headshot taken professionally by Nick, we can set that up. I'm kind of thinking to coincide with our next entrepreneur roundtable. So we could have the roundtable and we could also have the headshots going on at the same time. Would anybody be interested in something like that?
You guys should say yes. Like I got my headshots done by Nick and it's an amazing experience. And one of the best investments you can make in your business, a website and a good headshot, trust me, goes a long way.
Thank you, Andrew. Yes, I totally agree. Thank you for everybody for just popping it in. Okay, so there will be a bit of a cost involved. We'll cover a portion of his sitting fee, but there will be charge. It looks like it's going to be about $175. But like Andrew mentioned, it's definitely worthwhile. A professional headshot on all of your communication and marketing pieces, whether it be your website or on your LinkedIn profile, which I hope everybody has now, is excellent and it goes a long way. Oops. Oh, I'm going the wrong direction here. Okay, so finally, just to wrap up, again, big thank you to Andrew. As always, very informative.
Thank you, everyone.
Of course, anybody can touch base with Sydney or I if you have any questions.
And
listen, if you have
so just good luck. Just take your time with the spreadsheet, guys. At the end of the day, don't stress too much about it. The whole point is if you make mistakes during the assignment, that's okay. It's not like we're going to have another session where you're going to have some more detailed and specific questions that we're going to be able to go through. Okay. So like if you have a specific question about the retail situation that I didn't get a chance to go over, that we'll have tons of time just to go over the spreadsheet and more in the granular questions. Okay.
Yeah. And it makes it easier too, I think, Andrew, when you have your own numbers inputted, then you kind of can get a good understanding of it.
Absolutely.
Okay, so thank you everyone for joining us. And if I don't see you tomorrow at Artpreneur, we'll see you next Tuesday for, I believe it's our marketing session. Okay, have a great day.
Bye, everyone.
Bye.
Bye, thank you.